So do you want to turn $10,000 into $100,000? ETFs might be your ticket. But with so many options, how do you choose the best one for your goals? Imagine you are at the start line of a race with three contenders, the SCHD, the VGT, and the VOO. Each ETF represents a different strategy to reach your retirement dreams. Which one balances performance and risk to get you there the fastest? In this video, we will break down the specific strengths and challenges of each ETF, helping you find the one that offers the best performance without taking on too much risk. And as a quick teaser, if you had invested $10,000 into each of these ETFs 10 years ago, one of them specifically have earned nearly twice as much as the other two. And that's why we are going to compare these popular ETFs based on four key criteria: total performance, risk, diversification, and costs. Now that we have got you excited about these ETFs, let's talk about something that might make you a bit nervous: risk. But don't worry, understanding risk is actually the key to unlocking your investment potential. So, how do these ETFs handle the ups and the downs of the markets? Are they steady ships or wild roller coasters? So, think of risk like the weather. Some days are sunny and calm, while others are stormy and unpredictable. In the investing world, we measure these weather patterns using something called standard deviation. It's like a financial forecast that tells us how bumpy the ride might be. Over the past 3 years, VGT has been the wildest ride of the bunch. It's like the extreme sports of ETFs, thrilling but not for the faint of heart. On the other hand, SCHD has been more like a smooth sailing ship with the lowest standard deviation. And the VOO, it's right in the middle, offering a balance between excitement and stability. But that's not the whole story. Now let's talk about the scariest part of investing: losses. We measure this using maximum drawdown, which shows us the biggest drop an ETF has experienced in a specific period. Think of it like a water slide. How far does it go? Over the past decade, VGT took the biggest plunge. It's like the tallest, steepest water slide at the park, where the SCHD, true to form, had the gentlest ride down. And the VOO, once again, was just in the middle. So what does all this mean for you? Well, it depends on how much excitement you can handle in your financial life. If you are the type who loves a thrill and can stomach some big ups and downs, VGT might be your speed. If you prefer a more smoother, more predictable journey, SCHD could be your ticket. And if you want a little bit of both, VOO might be just right for you. But wait, because there is more to come. Now that we have talked about risk, let's dive into something equally important: diversification. And you have heard the saying, don't put all your eggs in one basket, right? Well, that's exactly what we are talking about here. But how do SCHD, VGT, and VOO spread their eggs? And more importantly, which basket might be right for you? So let's start with VGT. This ETF is like that friend who is obsessed with tech. It's all about IT sector, investing in 331 US tech companies. That sounds exciting, right? But here's the catch: it's also pretty risky. When tech booms, VGT soars. But when it busts, well, let's say it's not that pretty. On the other hand, we have SCHD. This ETF is more like a cautious friend who always keeps a savings account. It focuses on 100 US companies that consistently pay high dividends. And it's not as flashy as VGT, but it is steady and reliable. And then there's VOO again, the middle ground option. It tracks the S&P 500, giving you a slice of 500 of America's biggest companies. It's like having a buffet of stocks, a little bit of everything. Now here is where it gets interesting. VGT and SCHD are like oil and water. They only share 1% of the same companies. But VOO and SCHD have a bit more in common, sharing just over 10%. And what about VGT and VOO? They are like cousins with a 36% overlap. As the research says, VGT holds some of the most innovative and disruptive companies in the world, such as Apple, Microsoft, Amazon, and Nvidia, which have high expectations and projections for future earnings, growth, and price. So if you prefer a smoother ride with steady income, SCHD could be your ticket. And the research notes SCHD invests in high quality dividend paying stocks which tend to be more stable and resilient to market fluctuations. This ETF can provide steady income and growth, but also has limited upside. And what if you want a bit of both? Then VOO might be just right, offering a balanced exposure across various sectors. Alright, we have talked about risk and diversification, but now it's time for the main event. Which ETF is the true champion when it comes to performance? You might think you know the answer, but the numbers might surprise you. So let's take a look at how SCHD, VGT and VOO have performed over the years. But first let's talk about something that affects your bottom line: fees. The total expense ratio is like a small tax on your investments. VOO is the cheapest of the bunch, followed closely by SCHD, with VGT being slightly more expensive. But we are talking tiny difference here. All three are incredible cost effective. Now onto the juicy stuff: historical performance. If you had invested in these ETFs in 2015, you would be pretty happy right now. But one of them would have made you significantly happier. VGT has been the superstar performer with eye-dropping returns of 20.15%. And that's enough to turn $10,000 into a small fortune of $56,000. VOO, tracking the broader market, has also done well with a 12.5%, while SCHD has been the turtle in this race. It's been steady, but it hasn't kept up with the hares. Over this period, the SCHD returned to 10.91%, which is respectable, but not as impressive as its competitors. But here's where it gets interesting. VGT impressive performance comes with a catch. It's been a wild ride, right? Remember those risk measures we talked about earlier? VGT tops the charts there too. It's like a roller coaster with high ups and downs. The SCHD on the other hand is more like a gentle carousel. It might not give you the thrills, but it won't make you sick either. And let's not forget about those dividends. SCHD has been consistently paying out, which adds to your total return over time. And the VOO, it's been the Goldilocks of ETFs. It's not too hot, it's not too cold. It's given solid returns without excessive risk, making it a favorite for many investors. Now that we have seen the impressive performance of those ETFs, let's talk about the elephant in the room: diversification. Sure, VGT's been on fire lately, but what if tech cools down in the next 20 years? Are you ready to put all your chips in one sector? It's like betting your entire savings on one single horse. Exciting, but risky. And here is the kicker: can you really predict which market will lead the pack? And even the pros struggle with this. What if there's an ETF out there that gives you ultimate diversification in almost 9,000 companies, with companies from all corners of the globe? Then you want to watch this video. Imagine getting more diversified and still seeing incredible returns. Last year, investors saw a mind-blowing 22% return on investment with this mystery ETF. Could this be a game changer for your portfolio needs? Let's explore and uncover the truth about this potential investment superstar.